Hi, and welcome to Futures Discovery at John Lothian News. I'm your host, Cortez Draper. On this program, we'll embark on the fascinating world of futures and learn from top professionals in the field. Today, we're delving into the fundamental aspects of futures trading, the settlement showdown, physical delivery versus cash settlement. In the dynamic world of futures trading, how contracts are settled is a game changer, influencing strategies and risk alike. Join me as we explore the two primary methods that define this landscape, physical delivery and cash settlement. Let's kick things off with the age-old tradition of physical delivery. Imagine the tangible exchange of actual underlying commodities or assets from a contract seller to a contract buyer upon expiration. Authentic and tangible, but not without hurdles. From intricate logistics to potential shortages, physical delivery poses challenges that traders must navigate. Yet for some, this authentic and tangible nature holds undeniable appeal. Now, let's shift gears to a modern, streamlined approach, cash settlement. Here, instead of the physical exchange of assets, we're dealing with the settlement difference, the gap between contract and market prices. It eliminates the need for handling the actual commodity, but not without its complexities. From bias risks to potential price manipulation concerns, cash settlement introduces its own set of considerations and challenges. It's efficient, it's swift, but it requires an understanding of market dynamics, physical delivery, and its impact on trading strategies. For traders opting for physical delivery, the strategy revolves around managing the logistics and actual ownership of the underlying asset. This can influence trading decisions based on factors like storage costs, transportation considerations, and the physical condition of the commodity. Strategies might focus on markets where physical delivery is logistically feasible, considering factors like proximity to storage facilities and transportation hubs. The primary risk in physical delivery is associated with the tangible nature of assets. Traders face challenges such as potential shortages, quality control issues, and the need for secure storage facilities. Market considerations, weather patterns, and geopolitical events can also introduce unpredictability, impacting the successful execution of physical delivery. But the authentic and tangible nature can be a selling point for some traders, especially in markets where the physical condition of the commodity is a crucial factor. Opportunities may arise from discrepancies between the futures contract price and the actual market conditions, creating potential for arbitrage. Now, let's look at cash settlement and its impact on trading strategies. Cash settlement opens up trading strategies that are more focused on market trends and price differentials rather than the physical aspect of the underlying asset. Traders can concentrate on the derivatives that are more financially driven, using analytical tools and models to predict market movements. Bias risk tied to reference indices can pose challenges, as the settlement is based on the difference between contract and market prices. Potential price manipulation concerns can arise if market participants attempt to influence the settlement value for their own benefit. That being said, cash settlement allows for a more flexible approach, as traders are not bound to the logistical constraints of handling physical assets. Opportunities for speculation may increase as traders can focus on market trends and price differentials without obligations tied to the actual ownership. In conclusion, the choice between physical delivery and cash settlement significantly shapes the trading strategies, introducing distinct risks and opportunities. Traders must carefully assess their preferences, risk tolerance, and market conditions to align their approach with their method that best suits their goals. In this episode of Futures Discovery, we take a deep dive into the foundations of futures trading, exploring the traditions of physical delivery and the modern efficiencies of cash settlement. To get a more insightful view on how these settlement types play a role in the futures industry, let's talk to Jim Connor. Today, we're thrilled to have Jim Connor on the show. Jim currently serves as Senior Vice President at R.J. O'Brien, and he brings a wealth of expertise to our exploration. With an extensive background in the financial industry, Jim has navigated various roles contributing to the futures landscape. Today's episode is a deep dive into the settlement showdown, physical delivery versus cash settlement. Jim's insights and experience makes him a perfect guide to unravel the intricacies of these settlement methods in the futures market. Jim, thank you for joining us today.
Good morning, Cortez. It's nice to be here.
So on the importance of settlement methods, Can you elaborate on the difference between cash settlement and physical delivery, referencing your experience within the industry?
We've had experience with both, given our tenure at R.J. O'Brien. The physically settled delivery process is important, primarily because the delivery markets that are physically settled represent a physical supply of last resort. It's similar to the Federal Reserve System, where they are the supply of money of last resort. So we think it's extraordinarily crucial that, particularly within the commodity space and especially within agriculture, that physical delivery remains a foundation to how futures contracts are settled when we go into delivery.
Honing in on physical delivery and its fundamental properties within the market, like you said, Jim, the physical supply of last resort, I really enjoyed that. What are some of the strategies you implement when handling physical delivery?
Given the connection that agricultural futures have between physicals and settlement of a futures contract and delivery, it's important to be able to measure what the physical demand is for a futures contract and delivery as a physical supply of last resort. And the reason why this is important is that we run into different marketplaces in agricultural commodities, really on a back and forth sort of basis. There isn't enough supply of physical agricultural product available to the marketplace cheaper than physical supply from delivery. And this becomes an important risk management tool, because in physical settlement within agricultural commodities, when demand for physicals exceed the price of agricultural commodities when in delivery, then you start to see movement in the shapes of curves. As an example, if the physical market for corn is worth more than the physical delivery value of corn, then what tends to happen is that the front end of the curve strengthens and the back end of the curve ends up weakening on a relative basis. You're able to effectively hedge by buying the front end of the curve and selling the back end of the curve, or as we describe it, bull spreading, buying the front, selling the back, as a hedge. And it works very well when the relationships of physicals are within close proximity of the value of delivery physicals, the physical delivery process when we enter it. It's extraordinarily important.
When you're talking about markets, are you talking about contango and backwardation?
Yes.
The things that you're looking into? Well, if you don't mind, can you briefly explain to the audience what contango and backwardation mean and what it represents in the futures market?
Contango, another word for that is carry. That's when the front end of the futures curve is lower than the back end of the futures curve. Backwardization is the financial term. In the physical agricultural markets, it's referred to as inversion, where the front end of the curve is worth more than the back end of the curve. What determines whether the shape of the curve is in contango or backward dated depends on the relationship of physical bids for grain in a delivery period that is physically settled, and how we measure that. If it's above it, then the curve backward dates. If we're below it, then the curve moves stronger into contango. This is why physical delivery in agriculture is extraordinarily important. Otherwise, the volume of trade that would take place if it were financially settled would contract significantly. It obscures price discovery in the physical market considerably. When we have seen markets in agriculture where there have been attempts to physically settle grain, that market has attracted a confidence level within the speculative community that it represents the relationship between physicals and futures, represents a confidence to reality that it can be a supply of last resort. Financially settled contracts often completely disconnect from what's going on in the physical space. And a lot of that depends on how the financial settlement process is determined for an agricultural commodity. The preference in the trade, particularly for those that are speculating in the market, is that you have to have a foundation of confidence that physical delivery will perform as a supply of last resort. If it's not, then it's just the futures contract that is solving itself rather than solving the futures contract relative to the underlying physical.
So if it's all cash settlement or financial settlement, it allows traders or market participants to push the market higher or lower than the true market value. Would I be okay with making that assertion?
That's a safe assertion, particularly as it pertains to agricultural commodities that are traded at the CME that are physically settled. Typically takes place in three stages. The first of which is that when we have a lack of supply, physical supply, of an agricultural commodity outside of the delivery markets that force the underlying physical to be at a premium to the futures market as a supply source via physical delivery, then the next thing that happens is you get a backward dated movement or a movement towards backwardization in that commodity. Then the third step is after the cash markets have appreciated and you have a backward dated sort of spread, at some point in time, it signals that prices are too low and that they need to increase in order to expand physical supply availability outside of the delivery system. That is a very classic definition of a bull market. It is that sort of three-step process is crucial. Conversely, when there is plenty of physical supply that's available to the market cheaper than physical agricultural products and delivery, and the market moves into contango, what happens is that physical market is below delivery. The shape of the curve moves in contango, and then the next move is typically lower overall flat price. And that is a classic definition of a bear market.
Jim, we appreciate your time and insights into the intricate landscape of the settlement showdown, that physical delivery versus cash settlement. Your experience and expertise adds a unique and genuinely enriching perspective onto the markets, and it's now contributed to our exploration of financials futures. So Jim, thank you for being part of Futures Discovery.
Cortez, pleasure to contribute. Thank you.